Making moves, real estate community. I'm back. It's Tuesday, and it's your favorite host, Tim and Tim. I'm back from a long overdue vacation. Just got back from Maui for the last 2 weeks, and really excited to be back. Incredibly grateful and thankful for Tim Vest for covering the bases for me while I was gone, and I hope he provided a lot of good information for you guys, and you really enjoyed it. Tim, how you doing today, man?
Hey, not too bad. Just good to see you back on the East Coast, back in our time zone. You look a little more colorful these days.
You know, I'm not as pasty white as I used to be, and I really appreciate that.
Yeah, man. It looks like you got some good time in Maui and maybe a little good time on the water this weekend too. So
yeah,
rested up and ready to roll today, huh?
Ready to rock. I'm ready to get back to work, actually. I mean, it's fun going on vacation and all, but man, it's incredible when you're working for yourself and you really look forward to getting back to what you do. I remember we had that, quickly that conversation, and when we were working W-2 jobs, it was quite dreadful to say, oh, I got to go back to the office now, and I don't want to live for the weekend anymore. So that's why we started to do what we do, and that's why all of you guys are here too, because you want to learn how to do that. And we got an amazing guest with us today. His name's Scott Hill. He is a good friend of mine. We've had some really awesome conversations. The guy's been to Maui a bunch of times. He started his career in 1983 as a bond trader in San Francisco. And he's passionate about discovering tax reduction strategies and eliminating portfolio fees. So Scott has a really unique ability to help with strategies. And, I think at one point in time you had done some capital raising for some syndications on Wall Street. And I'd love for you to, I know that it's been a while since we've spoken, but I'd really love for you to give a good high-level overview of who you are, what you do, what your experiences are, and what you like to do. So without further ado, Scott, thanks for being on today.
Thanks, Tim. Appreciate the time. Welcome back, by the way.
Thank you.
A little bit of background on me. I know we're kind of limited on time, so I wanted to give you a 30,000-foot view of myself and what we're going to be talking about here this morning. I started my career out in San Francisco, as Tim had alluded, with Dean Witter. I was an institutional bond trader, and I moved to the Southwest in Oklahoma, managed an office there for them, and I was there also their limited partnership Southwest regional manager. So we did a lot of private placement stuff. We did a lot of public offering stuff. So I'm familiar with a lot of the limited partnership background and raising money and having investors go into public and private limited partnerships. So my main focus traditionally has been creating income, tax advantage income for people as they're approaching retirement. I deal with retirees predominantly, and on the one hand, it's great making money, but if you don't know how to hang on to it and not give it off to the tax man, it's kind of a fool's errand. So this is really talking about people who they want to sell their business or they want to sell their piece of real estate, but they're tired of kicking the can down the road. They don't want to do 1031 exchanges anymore. They don't want to owner finance and live with the new buyer. This is for people that want to mitigate a lot of the capital gains taxes, state taxes, even net investment taxes, things of that nature. So this particular project that we're going to be talking about this morning is going to afford sellers the opportunity to not have any fear that they're going to lose money somehow to taxes when they do the sale, because it'll hit them immediately the year that they do sell. And if, like I say, if they're doing the installment sale or some sort of owner financing, they don't know whether the new buyer is going to be able to hang in there long enough, to be able to successfully run the property, run the business, that kind of thing. So it gives everybody a clean break to be able to kind of walk away and know that everybody's taken care of and everything's secure. So.
Yeah, one sec before you go on, I want to stop in here real quick, and I want to tell the listeners why this is important. This is important because if you're doing direct to seller marketing, this is another tool that you can put in your toolbox to provide the seller an option for how they can mitigate their taxes. Right? What's the number one problem, Tim, that we hear about when you're going, Jacob Reed with the 170 exchanges? That's another one too. We should have Jacob. We got to have you on here to talk about that. But this is another tool to have in your toolbox. So when the seller's like, "Oh, I don't know what I'm going to do because of taxes," well, you can connect them with people like Scott Hill, and you can say, "Hey, I know a guy that does X, Y, Z that can help you with that." Because it's so funny to hear along the whole real estate ride. Everyone's always talking about 1031 this, 1031 that. Just keep kicking it down the road. Eventually, you get to a point in time in your life where you don't want to do that anymore, and that's why this is so important. Because I think it brings a lot of value to the community. Because it's not just the come up. It's once you've reached the top of the mountain, then what? Right? This is what we're talking about now. Is you're at the top of the mountain, and people want to buy your property. You don't want to deal with taxes anymore. You don't want to deal with 1031. What do you do? Now, this is where Scott comes into play, and knowing someone like Scott can be very beneficial for your negotiation tactics with a direct-to-seller property. Okay, go ahead.
Good. So what is a structured installment sale, basically? So effectively what it is, best description is the seller sells the piece of property. All this has got to be done before the actual sale takes place. So you got to meet with your CPA. You got to make sure tax-wise that you're getting the right benefit, kind of as a disclosure on that. But basically what happens is owner sells the property. It actually goes into what's called a non-qualified structured installment sale. And what they have the ability to do is they can defer the payment out to 35 years. So what they're doing effectively is they're creating a systematic, completely designed income stream that they can pick anywhere from 1 year, 2 year, 5 years, all the way out to 35 years to spread that out. So when we take a look at what kind of payment they want, those payments are made a lot smaller over time, as opposed to taking it, right there up front the year that they actually sell the business. So the net effect on that, I'm going to show you some examples of what that is and how it operates. But these, as I had shared with Tim earlier on, these types of structured installment sales have been available in this particular type of format for about 30 years. This is not something new that just got cooked up. So there's a lot of Internal Revenue Code precedent with how these function and operate. Here's the difference between this particular format, which is called iStructure. What they've done, as opposed to MetLife, some of these companies that have done these before, they actually are able to give returns on this that are linked to the market. So a lot of people, when they cover their money and they decide that they want to do one of these installment sales, effectively they put it into something where they're not getting a return. So if you're sitting there with your money and you're not keeping up with inflation, you're not keeping up with your money growing. The difference with this is this is a market-linked settlement program where your money is actually growing without risk, without fees, and you're averaging really good rates of return as you're getting those payouts over time. Okay. So what you're trying to avoid typically three taxes. You got federal income taxes on this, capital gains tax. You got state income taxes potentially. You've also got a really interesting tax called a net investment income tax, which is a flat fee of 3.8%. And it's kind of a like alternative minimum tax, but these things really add up pretty quickly. So again, this is something that is not, it's not going to be something that works in every particular situation. As Tim said, it's another golf club in your bag to pull out when you run into somebody that says, hey, I'd love to sell, but I don't want to pay the taxes. That's the purpose for doing this particular format. So what this particular structure is, the landing page is strategypartner.com. So you can go on that, look at it, ask a lot of questions as to how it works. But effectively, what you're doing is you're putting this into something that is safe, secure. And let's go to some examples. Tim, if you'll pull up the example of the real estate for just a moment.
Yeah, one second. Share here. And so we got a question. So Jacob Reed, as you're going for the tax strategies, M443, monetized investment sale. Is that relative to what you were talking about? I'm not entirely. Jacob does 170 exchanges, so he's way more familiar with these types of strategies than I am.
You're breaking up really badly, Tim.
Oh, am I? Oh, geez.
Yeah. So let's go through this real quick. Do you see this? Meet Jack and Jill.
One second. Is it this one? Or this
All right.
one? Oh, Jack and Jill. All right.
All right. So here's the real estate example as a for instance. Now this can be done. Obviously, we're talking multifamily. We're talking, the self-storage units. We're talking even rental properties, things of this nature that are highly appreciated. These are designed for highly appreciated assets. So in this particular example, you've got Jack and Jill. They live in Florida. They've got rental property in Florida, and they would like to sell their property. They got an offer of $1,025,000. Their basis is $200,000. So they've got $825,000 of long-term capital gain, and they're trying to figure out what do they do to mitigate the taxes. So they've got these choices. They can sell the property, pay a huge tax bill. They can do a 1031 exchange, or they can do the structured installment sale that we're talking about. So as we roll down a little bit further here, the $1,025,000 sale of the property with a cost basis of $200,000, $825,000 long-term capital gain. What they're looking at is a 25-year payment on this. And again, as I said earlier, with the structured payment settlement, you can roll that out anywhere from a couple of years all the way out to 35 years as a max. And you can actually delay having it turned on, and you can decide that you want to maybe start taking the income 2, 3, 4 years down the road. So again, it is completely customizable. So the total expected benefit that they would get in this particular case by doing the structured installment would be $2,157,278. You see that? Now, if you take a lump sum payment, again, what you're looking at, Jack and Jill are going to receive the proceeds from the sale of the property. If you did this lump sum, they'd have to pay about $123,000 federal capital gains. And again, we mentioned the additional $21,877 due to the 3.8% investment income tax. So that would be a total tax of $144,798. If they went with a structured payment settlement, that particular tax over that spread out over that 25-year period, they would pay a total of $30,984. Huge difference. So they're going to save $113,000, almost $114,000, and they're going to realize $2,157,000 as opposed to, and the net payment would be $2,126,294. So again, they can spread it out. They can design this. It's effectively designed. Best way that I could describe it would be like rolling the proceeds of the property into an IRA. And that IRA basically is protected from the taxes until they start making withdrawals. So those withdrawals, let's talk about the payout. When they start taking the money in a constructive receipt type of format, they are only taxed on what they pull out on an annual basis. Part of that is going to be basis, which of course is not going to be taxed. Then you've got the portion of that payment that is the long-term capital gain, which has to be paid. And then you've got the state income tax, if any, depending on where you live. And so that's how that is particularly paid out. So this is how that would work for this particular couple. Again, they're saving quite a bit of money. If we take a look at again, the net, roll down, if you will, Tim. Can you see it? So you've got the structured installment sale. Again, you've got a total of long-term capital gain and taxes, no net investment income taxes, no state income taxes. So over the entire 25 years, they paid out $30,984 in taxes. And again, the outright cash sale would produce in the year that they sold $144,798. They do have the ability it's not an all or nothing. If they wanted to take part of that money and do the structured installment sale, they can do that. And then they can take the remainder proceeds to do whatever they want to do. A lot of times people want to take some of those proceeds and maybe buy a new house, get a motorhome, those types of things. So when they do sell the property or the business, they have the ability to design this in such a way that they can put in what they want to defer. And again, a lot of flexibility and tremendous benefit for people that say, this is it. We want to be able to create income for the rest of our lives.
So Scott, what kind of situation is this good for? Obviously deferring taxes, but can anybody that owns property take advantage of something like this, or are there certain situations where?
Absolutely.
Yeah. Go ahead.
Yeah. So what happens with this is actually put into an escrow-like account. Again, I'm going to not go through all this. You can go to the landing page and get all the details. But this is for people who, I would say generally, it's for older people. If you run into an older couple, they don't want to manage their apartment complex, or you've got someone that has gathered property, rental property, second, third, fourth homes, which I run into that quite a bit with the people that I deal with. They say, hey, I'd really like to sell the property, but I don't want to continue again to do 1031 exchanges or keep rolling up and that kind of thing. So this is really designed for people that, you want to get the hands on the money. I mean, it's nice to be able to look at the value of a piece of property and watch it grow. But at some point, people actually want to get their fingerprints on the money and actually utilize this for something. So this is for the person, generally, I would say, that tends to be older, that want to cash out and they want to live the rest of their life and have a good, steady income stream that's tax advantage, quite simply.
Got it. Okay. Thanks for that. Hey, I don't know if you can see it, but Jacob Jennings had a good question on the chat there. Is the fiduciary registered dealer status?
No. What this is, let me be real clear. This is actually an annuity, a government-approved annuity. And there's certain types according to Internal Revenue Code 453. And so what they have done, this is all government structured, it is all government approved, and it has to fit certain parameters. So this isn't something that is a security of any kind. It's not fiduciary ruled or any of those sorts of things. On the landing page, you'll see an article that came out in CPA Journal about this specific program. It goes into all those details. I won't take up a lot of time, but bottom line, this is, again, a structured payment is in fact an annuity, and it's got to be the right structured one. Again, the details are going to be on that landing page.
Okay. So a little background, like how did you come across these things? Because most folks only know sell or 1031 exchange, right? Or maybe some seller financing kind of thing. How did you run across this?
Well, again, I've been doing the type of retirement planning for years and years, and I have a lot of, as you might imagine, like y'all, I've got 40 years of contacts, people that contact me and reach out to me. And this was something that was presented. It was brought to me to take a look at. And it's one of those, when you run into something that you see that's right place, right time. And of course, being a member of the group, my first million in multifamily, and having met you, Tim, I looked at this, and this, so again, was presented to me, and I thought, this might be a very good application given people that probably don't run into this kind of thing very often. You've got your method of, owner financing, this kind of thing. And when I looked at this, I thought, this could be a right place, right time, given the right circumstance. So again, I get presented with a lot of things. People want me to show things to investors. They want me to talk tax strategies and things like this, which is what I do. I speak around the country on tax savings and those types of things, creating income. And this was something, again, that was presented to me, brought to me, and we kind of brainstormed and thought, well, how would this be applicable? And so here we are, very simply.
Got it. All right. So that's good information, and thanks for sharing that. Mr. Jennings has another good question here, and
Mhm.
you're kind of playing in his wheelhouse a little bit here. So I'm sure he's very interested in this. But what is the difference between this and a monetized installment sale?
Well, again, if you're talking about in an owner financing type of context, that particular context, it very oftentimes, the seller is living with the people that have purchased the property, and they're relying on them not to default, that they're going to make payments, but there's no guarantees. The difference with what I'm referring to and doing what you've referred to, this is all guaranteed, no risk, no market fluctuation. It's effectively, it's with an escrow company that ensures that these payments are made. It's a clean break situation. So the client wants to go do their thing, the purchaser wants to do their thing. It just affords them a clean break to walk away more effectively. Bottom line.
Got it. Got it. So you got a good deal of information on these sitting out there on the landing page, and I think we dropped it in the chat here with exitstrategypartner.com.
Mm-hmm.
Is there any other information you can share on how folks can reach out if they're interested in talking to you about these? Because Tim and I come across people all the time who want to sell a property, but they don't know where to place their 1031 and things like that. So this
Sure.
might be a good way to offer an alternative. So what's the best way to get in touch with you besides the exitstrategypartner.com?
That particular landing page has my information on it. When they take a look at that at the bottom, it'll have the contact information. My contact information is, if you're there and you're writing it down, scotthill2@me.com. You can reach out via email. My office number is 770-712-4006. And if you will reach out, and we'll talk through the kind of the ins and outs of what you're trying to accomplish, and we'll begin the process. But again, I will tell you that you got to line all this up prior to the buy-sell agreement. You've got to incorporate this with the CPAs to make sure that it's all embedded properly, so that stress tests properly to be able to meet this particular structured installment sale guidelines. So we'll talk through it. It does take a little bit of time to put together, but reach out to me. We do have staff that we will compile this. And Tim, I think I shared this with you, kind of give you a little bit of an overview, but we've got the calculators, the number crunchers, all of that we can vet this out and make sure that it's right place, right time for the right people.
Gotcha. Yeah, now you're talking Vitali's world right there. Number crunching and calculators, man, he's all about that.
Yeah.
Oh, yeah.
So, hey, Tim, are you talking?
Can you hear me better now? Is it not breaking up anymore?
Yeah, man,
I hear you fine.
Okay,
so
I
much
ended up
better.
like unplugging all the stuff out of the back of my docking station and plugging it back in. I think that was what was going on with it. But Scott,
you're crystal clear now.
Good.
Yeah, every bit of this, it's called iStructure, guys. And every bit of this is completely customizable depending on what the client wants to do. So again, it's extremely flexible, extremely beneficial to the right people. If you want, before we sign off, can you go to the business example?
Scott, I don't think we're going to have enough time, honestly, to go through another example.
That's fine. That's fine. So yeah, I mean, this is again, it's basically all about the taxes, guys. And
Yeah.
if you think taxes are going up, like I do, going forward, this is going to be a pretty powerful tool to help protect people in what they've spent a lifetime trying to build through real estate appreciation.
Right.
Yeah.
And the number one thing about most people will tell you is about investing is investors are not worried about as much of what the returns are going to be. They're more concerned about how they're going to get their money back. Right.
Mm-hmm.
And by avoiding taxes and by avoiding not avoiding, but deferring taxes and finding tax strategies in order to mitigate the risk is the most important thing to preserve what you've built, just like you had said. So, Scott, thanks a lot. I really appreciate you coming on and talking about what you're doing. I think it's powerful stuff. And you've already, maybe we'll put your information in the notes there so people can get in touch with you. But really appreciate you coming on, and looking forward to chatting with you again soon.
Happy to help, guys, and always a pleasure. And anything I can do to be of service, you got the contact information, and I'm happy to help.
Absolutely. Thanks, Scott. Talk to you soon.
All righty. Take care, guys.
Thanks.